Will house prices crash in 2023? Hi, my name is Chris Peel from Property Abundance, and in this video we are going to deep dive this particular question. Now, it's a very common question on the lips of a lot of our mentorship clients right now as well. Is now a good time for me to be buying property given the things that are going on in the world? Now, before we dive into this, I want to caveat this and say, look, I don't have a crystal ball the same as anybody else, but what I do have is a seven-figure property business. So it's kind of in my interest to understand the mechanics at work behind here. So let's break them down, let's go through them, and let's understand what impact they have on the market so that we can get a best guess as to what's likely to happen to property prices in 2023. Now, the first one to pay attention to is the market trajectory. Okay, we already have a declining market. That means every single month, property prices have fallen in value for the last 3 months, in fact. So our first factor is trajectory. Now, what do I mean by that? Well, this is what is the market already doing? Okay, what is the market actually responding to? Now, in October, it fell by 0.9%, in November by 1.4%, and in December by 0.1%, according to Nationwide. Now, they are a really, really reliable mortgage provider and keep a close track on UK house prices. So anything that they forecast, we can take as pretty much correct. Okay, now obviously we always need to check the source of our data as well. So if we already have a falling market, we have this trajectory going down, you get what's called momentum in markets, where you get like a vicious cycle or a virtuous cycle. In this particular case, a vicious cycle where house prices start to shrink, so people tighten their belts, so less people buy houses, so house prices demand falls and therefore price shrinks. So you get this spiral effect. Now that also happens the other way as well, by the way, on a rising market. But if we take that into account, if we consider the fact that we already have this falling market, that is one of the things that's going to play into this picture. Now the second thing is what's called the earnings to price ratio. Okay, so the E to P ratio. Now this is a measure that tracks the difference between the average earnings that people are making, i.e. average salaries, versus the average price of the average UK property. Now, obviously, the more expensive houses get compared to average earnings, the less demand there is, or the less affordable they become, we should say. Not necessarily less demanded, because people still want to live somewhere, but certainly the less affordable they become for more people. Now, right now, we are in fairly unprecedented earnings to price ratio. We're at a ratio of over 8. Now, that means that for someone to buy the average property, it's going to cost them 8 times the average annual salary. Now, we have not been in this position since literally 1914. The start of World War I was when house prices were previously as high in terms of earning to price ratio as this. So again, we need to think, what does that actually mean for the economy? What does that mean for people's wallets and their ability to be able to A, save up a deposit, but also B, be able to afford the monthly repayments? Now, again, let's just unpack it a little bit. If we've got to save up a 25% deposit, but the average house price has never been higher compared to salaries, all of a sudden this becomes the most out of reach thing. Okay, it becomes more difficult for people to achieve. Now, that's for investment property. For personal house buying, you only need to have a 5% deposit if you're on a Help to Buy scheme. But still, it's still harder than ever for people to save to be able to afford the average house. Again, that's going to have an impact on the amount of demand, the amount of people queuing up to buy them, and therefore less demand equals lower pricing. The third thing that we need to account for, and this factors into this piece around having to save up and use mortgages, is interest rates. Now, again, right now, the Bank of England interest rate at the point that I'm recording this is 3.5%. If you convert that into mortgage rates, for a personal home buyer's mortgage, you're looking at rates of around about 6% right now for a 5-year fixed. Now that, again, is historically, compared to the last decade of interest rates, that's a lot higher. Okay, so that means, again, that it's becoming more unaffordable for people to be able to buy their own houses. Because every single month, instead of their mortgage costing them, let's say 300 quid a month, because they were used to 1 to 2%, all of a sudden now that's kind of doubled. So to buy the average house previously, okay, yeah, aside from saving up deposits, was costing them £200 a month just to service the mortgage or whatever the actual cost was. But now the interest rate's pretty much tripled. So that means that the average payment's pretty much doubled. So again, this is having a massive impact on people's ability to afford their mortgages. Now again, let's extrapolate that out. What does that actually mean for the market? Well, firstly, it means that you've got a bunch of people who have paid for expensive houses, whether or not they could afford them at the time, but they've made purchasing decisions based on previous interest rates. Now, again, if we look back over the last decade, interest rates have been at a historic low. Okay, a historic low. Ever since like the 2008 recession, where interest rates plunged, they haven't really rebounded from that, and they've stayed low. So everyone's got used to them being so low. So you get this herd mentality of, oh, well, interest rates are 1 to 2% right now. They're not going to be higher than that. But now we're sitting on an average interest rate of 6%. So people have bought assuming that it's going to be 1 to 2% and continue to assume that it will continue to be 1 to 2%, and now find themselves in a position where their existing mortgage is unaffordable. That means we're going to get into a situation where people are going to be forced to sell. So interest rates rises leads to more supply, because as people's interest becomes more unaffordable, people are forced into a seller's position because they can't afford to service their mortgage. Now, if you don't pay your mortgage, what happens? The bank comes and takes your house. Now, people obviously don't want that to happen, and that's a terrible thing for anyone to experience. So it becomes a point where people have to sell and get desperate to sell. And when you get that seller's desperation, that's where prices start to take a tumble. So again, if we factor in the fact that interest rates are at an all-time high and the impact that that's going to have on supply and demand, then I think, again, that's a big, strong indicator of the fact that prices may fall. Now, beyond that, and this factors into it, on top of interest rates being at an all-time high, we also have inflation. Okay, inflation in the UK right now is still over 10%. Now that means that prices for just the ordinary day-to-day living costs are going up at a phenomenal rate, because driven by, firstly, interest rates, but secondly, obviously we have the conflict in Ukraine have driven up utility prices. Again, they have started to fall, but we're not seeing that as consumers right now. Wholesale prices are down, but retail prices aren't, because they bought the wholesale at expensive rates, and therefore they're having to filter through. Now again, I'm not going to get into the whole conspiracy theory about whether they'll ever get into us, and whether our prices will ever fall again for that, but let's just think about the property implications. If inflation's up at 10%, that means, again, it factors into this same question. Can people now afford the house that they could before? You know, if they bought something that's a bit bigger, just because they had the money, interest was cheap, and therefore they wanted to buy something a bit bigger for themselves and their family if they were planning on having kids, but now all of a sudden their interest payments have gone up and therefore their mortgage costs gone up. But on top of that, utility bills have never been as high as they have been. Council tax bills have gone up, and just the cost of living has gone up. Again, it factors into this. Can they actually afford to service that mortgage? And will we see people starting to A, default, and B, get into desperate selling positions where they have to sell their house? Now, again, to compound this even further, we have banks kind of throwing their thing into the mix as well, just making this even more compounded by raising the stress tests. Okay, they've raised what's called a stress test. Now, what do I mean by a stress test? Well, this is what a bank does, or a mortgage provider does, to check that you, as the borrower, can actually afford that mortgage. So what they do is they test and they assume, well, look, if interest rates went up to 8%, which is what they're stress testing to right now, if they're stress testing as high as 8%, can you afford the mortgage? Well, that means for a lot of people who could afford it at 5% but can't afford it at 8%, they're not going to be able to get that mortgage in the first place. So if you have less finance available in the market as well, that results in a contraction in demand. Not necessarily people don't want to buy them, but people can't buy them because they can't physically get the mortgage because they can't afford that extra stress test. So you end up with not only the earnings profit ratio, not only do we have trajectory, not only are interest rates up, causing less demand and more supply, not only is inflation at an all-time high, and again, driving a need for people to sell and less demand for people to invest, but also the lenders are making it more difficult as well. Now, what does all this mean? Well, it means that if I'm going to make a prediction, I believe the market trajectory will continue. I think we will continue to see a falling market. I just can't see, looking at these more macroeconomic factors, how we can continue to, how it could do anything else. So, if I'm putting my hat on one of the pegs, I'm going to say that, I think the market will continue to fall. Will it be a crash? I don't know. I don't think anyone knows, but I think we are going to see a fall. Now, what does this mean for your property strategy for 2023? Well, look, it means there are buying opportunities coming. Okay, there are going to be some people who have bought something they can't afford. They need to get rid of it. Now, they have two options. Either they sell it at a discount, and that's where you can pick things up at good prices, or they're going to end up going and getting repossessed if they don't keep up with their mortgage payments. So, huge buying opportunity coming. Now, by the way, if you found this kind of content useful, if you find like you want to get regular updates on the property market, please make sure that you like, comment what your biggest concern out of these macroeconomic factors is for you, and also subscribe to the channel. It just takes one click. The subscribe button is right down below here. Now, I'm going to be bringing you regular content on the property market, on the updates from my own 7-figure property business as well. So make sure you subscribe to that. But if you want to know a bit more about how we can help you, we're actually offering some free consultation calls with my team right now as well, just to understand where you are right now, what you need help with in your property business, and if it's right, whether we might be the right partner to help you with that as well. Completely no obligation, completely free. The link, if you want to book one of those, by the way, is down below in the description. Hope you found this video really interesting. Make sure you subscribe so that you can get regular content like this to understand and inform your property business in 2023. My name is Chris Peel. I'll see you soon.